Welcome to the Accounting Desk. In today's session, we explore the essential aspects of Ipsas 18, segment reporting. Have you ever wondered how detailed financial disclosures can improve accountability and decision-making in the public sector? In the next 10 minutes, we will break down Ipsas 18, its objectives, and many critical elements that contribute to greater clarity in public sector financial reporting. Our goal is to help accounting professionals, students, and public sector financial officers understand the standards step by step. Ipsas 18 is all about enhancing transparency and trust in governmental financial statements. It provides a framework by which public entities present their financial performance, not as one monolithic number, but as a collection of segments. This approach allows stakeholders to better discern where resources are being used and how different segments perform. By the end, you will have a clear understanding of the objective, scope, and intricacies of segment reporting within the public sector. Let us begin with the first key element, the objective of Ipsas 18. The main goal of this standard is to enable users' financial statements to understand the performance, position, and cash flows of distinct segments within a public sector entity. Imagine a financial statement that is not just a summary of overall numbers, but a detailed account of the activity areas. That is the power of segment reporting. It improves accountability among decision makers and provides clear insights that support resource allocation decisions. By focusing on both service and geographical segments, entities can mirror how management internally tracks operations. Now moving on to the scope of Ipsas 18. This standard applies to all entities that prepare financial statements under accrual basis Ipsas. It is important to note that government business enterprises are excluded from this standard since they follow a different set of rules, IFRS. In other words, Ipsas 18 caters to a wide range of public sector organizations, ensuring that each entity reports its segments accurately. With this broad application, the standard reinforces consistency in how performance is measured and disclosed across many public bodies. After understanding both the objective and scope, let us delve into the concept of a segment. What exactly is a segment? A segment is defined as a distinguishable activity or a group of activities whose financial information is reported separately. It could be a service segment, such as health or education, or a geographical segment, such as specific regions or districts. The idea is to capture important parts of an entity's operations so that users grasp the unique financial implications of each part. For example, consider a public institution that provides both healthcare and educational services. By reporting each service separately, stakeholders can see which one is performing better, where investments are needed, and if resources are allocated appropriately. This clarity is indispensable in a world where decisions are data-driven, and each segment represents a critical function of the entity. Let's now explore the basis of segmentation. In practical terms, segmentation is largely based on the internal reporting structure adopted by management. Entities must choose a segmentation method that aligns with how they monitor and manage their operations. Typically, segments will reflect major activities or service lines. In practice, you might see a Ministry of Public Works organizing its segments into categories such as urban infrastructure, rural roads, and flood management. The internal perspective helps ensure that the segmentation closely mirrors the entity's priorities and operational structure. At this point, it is time to address one of the most critical aspects, identifying reportable segments. For a segment to be reportable under Ipsas 18, it should represent a significant portion of the entity's operations. The commonly used threshold is that a segment's revenue, expenses, or assets should account for 10% or more of the total. Moreover, these segments are regularly reviewed by senior decision-makers, ensuring that what is reported truly reflects the organization's operations. Why is this significance so important? A segment that meets these criteria highlights a key area of the entity, allowing stakeholders, including government bodies and citizens, to obtain a more detailed picture of performance and efficiency. When different segments are evaluated, organizations can then allocate resources more judiciously and improve their overall management practices. Furthermore, segments that do not meet the threshold can sometimes be aggregated with similar ones, thereby offering an even clearer narrative on operations. Speaking of aggregation, it is essential to discuss the process by which similar segments can be combined. When segments share similar economic characteristics, offer analogous services, or operate under like regulatory environments, they may be aggregated for reporting purposes. This not only simplifies the reporting process, but also enhances the clarity of the information presented. In essence, combining segments helps in avoiding information overload, while still painting an accurate picture of the entity's operations. We now come to the segment information that must be disclosed. Ipsas 18 mandates several minimum disclosure requirements. For every reportable segment, entities are required to provide detailed financial information that includes segment revenue, expenses, and the resulting surplus or deficit. In addition, disclosures should cover the corresponding assets and liabilities, as well as the specific basis on which the segmentation is based. This level of detail is designed to ensure comprehensive coverage of each important financial component, enabling an accurate assessment of each segment's performance. Another critical aspect of segment reporting is the reconciliation process. Entities are required to reconcile total segment revenues to total entity revenue. Similarly, segment assets must be reconciled to the entity's total assets, and the segment-level results should correlate with the overall financial result. Such reconciliations help verify the consistency of the reported data and serve as an additional layer of transparency for stakeholders evaluating the entity's financial health. Although segment disclosures are fundamentally derived from internal management reports, there are notable adjustments that must be made for external financial statements. In instances where internal reporting methods differ from the basis used for general-purpose financial statements, it is essential to disclose the measurement methods applied. This transparency allows financial statement users to understand any variances and to compare internal performance with overall financial outcomes. Next, let us move to the measurement principles that guide segment reporting. Consistency is at the heart of these principles. Segment information is required to be measured on the same basis as the information presented in the general-purpose financial statements. However, in the event that different measurement bases are used, entities are required to disclose the methods employed. This approach ensures that users of the financial statements are fully informed about the underlying figures. In addition, when revenues or expenses are shared across segments, they must be allocated on a reasonable and consistent basis. The method of allocation itself should also be disclosed so that users can understand the mechanics behind the reported figures. Now we turn our attention to the advantages and limitations of segment reporting. One of the chief benefits of this reporting method is that it greatly enhances transparency. By detailing individual segments, stakeholders receive a clearer picture, which aids in making informed decisions. For instance, when resource allocation decisions need to be made, having detailed segment data can guide investment towards the areas that are most in need. Moreover, this detailed reporting improves accountability across departments and functions by allowing for performance comparisons that would otherwise remain hidden within aggregate figures. In addition to these advantages, segment reporting supports better decision-making by providing regulators, parliamentarians, and the general public with direct, data-driven insights. However, it is important to recognize that these benefits come with certain challenges. The process of capturing segment data can be both complex and costly. Public entities must invest significant effort in gathering and maintaining the data, which can sometimes become a barrier to timely reporting. Moreover, the criteria used for defining segments contain a degree of subjectivity, meaning that in some cases, decisions on segment classification might vary between entities. Confidentiality concerns may also arise, particularly when sensitive information is involved. Balancing these benefits and challenges is essential for entities as they navigate the intricacies of Ipsas 18. To illustrate these concepts more concretely, imagine a local government divided into 3 key departments: public health, sanitation, and urban planning. Each of these departments operates as a segment with its own set of financial data. In a typical segment reporting scenario, the government would present revenue, expenses, assets, and the surplus or deficit for each department separately. Visual aids, such as tables showing these figures, help the public see exactly where funds are being spent and the performance of each department. This method not only instills trust in the reporting system, but also highlights areas where improvements or reallocations may be necessary. As we draw nearer to the conclusion of this session, let's recap what we have learned about Ipsas 18. We started by understanding its primary objective, which is to improve transparency and accountability in public sector financial reporting. We then discussed the wide scope of the standard as it applies to nearly all entities operating under accrual basis Ipsas, with the exception of government business enterprises. Next, we clarified what constitutes a segment, including the types of segments and the basis upon which segmentation is determined. We have also explored the detailed criteria for identifying reportable segments and the process of aggregating similar segments. Additionally, we examined the mandatory disclosures, the role of reconciliations, and the challenges that come with measurement principles and allocation methods. Finally, we acknowledged both the significant benefits and notable limitations of segment reporting. While enhanced transparency, improved decision-making, and accountability are major advantages, the complexity and cost involved, along with subjectivity and confidentiality concerns, present real challenges. It is by weighing these factors that public sector entities can truly harness the power of Ipsas 18 while mitigating its drawbacks. Thank you for joining us on this detailed exploration of Ipsas 18 segment reporting. We hope that this session has deepened your understanding of the principles, issues, and practices that underpin effective public sector financial reporting. Remember, the clarity offered by segment reporting not only aids in transparency, but also fuels better decision-making and ultimately strengthens public accountability. If you found this video informative, please like, subscribe, and turn on notifications for future content. Stay tuned as we continue to bring you the latest insights in public sector accounting. Your journey towards clearer, more accountable financial reporting starts here.